On June 3, 2025, Bitcoin continues to hover above the $105,000 level, trading at approximately $105,622 at the time of recording. This follows a brief intraday high of $106,809, reflecting sustained bullish interest despite mixed signals from broader financial markets. The $100,000 psychological barrier, once considered a moonshot target, has now become a floor that Bitcoin appears determined to defend. This price stability comes amid a flurry of market activity. Volatility remains elevated, with many traders noting sharp intraday swings and whipsaws around key resistance levels. What's interesting is that this consolidation above $100,000 hasn't triggered the sell-off some analysts expected. Instead, we are seeing a mix of cautious optimism and long-term conviction, especially from institutional holders. Ethereum has also staged a notable rally, climbing 5% to trade at $2,616. This resurgence is fueled in part by institutional flows returning to altcoins, particularly those with smart contract functionality. Analysts point to data showing that over $1.2 billion flowed into Ethereum-linked products over the past 30 days, coinciding with rumors of pending upgrades to Ethereum's scalability infrastructure. The so-called proto-danksharding initiative is seen as a game-changer for Layer 2 applications. Bitcoin ETFs, on the other hand, are showing signs of strain. According to data released this morning, the top 10 US-listed spot Bitcoin ETFs recorded a combined outflow of 2,858 BTC, equivalent to about $301.5 million. Notably, BlackRock's iShares Bitcoin Trust saw the largest daily outflow, losing 1,250 BTC. While some interpret this as a bearish signal, others argue it's simply a rebalancing, as investors rotate into more volatile or discounted assets like Ethereum or Solana. And yet, this ETF data doesn't paint the whole picture. Despite the outflows, on-chain metrics show that the percentage of long-term Bitcoin holders, those who haven't moved their coins in over a year, has reached an all-time high. Over 70% of circulating Bitcoin is now considered illiquid, indicating that most holders are not interested in selling anytime soon. This creates a supply squeeze, which could act as a tailwind for prices in the medium term. Meanwhile, the Bitcoin mining sector is surging. Riot Platforms, one of the largest publicly traded Bitcoin mining firms in the US, announced that it mined 514 BTC in May, an 11% increase over April and a whopping 139% year-over-year surge. The company monetized nearly all of its newly mined coins, generating $51.3 million in monthly revenue. Riot has also upgraded its mining fleet, with its average energy efficiency now outperforming most of its competitors. MARA Holdings, formerly known as Marathon Digital, posted even stronger figures. The firm mined 950 BTC in May, up 35% from the previous month. Its hash rate has now reached 58.3 exahash per second, cementing its position as a global mining leader. This level of computational power is not just about profitability, it's also about influence. Companies like MARA and Riot are beginning to shape mining policy discussions, particularly around energy sourcing and geopolitical decentralization. Speaking of energy, there's growing interest in sovereign mining projects. Pakistan recently announced plans to establish a national Bitcoin reserve by using surplus hydroelectric power for mining operations. This follows El Salvador's example, but with an emphasis on state-owned mining infrastructure. The implications of countries holding Bitcoin on their balance sheets are profound. It positions Bitcoin not just as a speculative asset, but as a geopolitical tool. Now, let's zoom out and look at the macroeconomic landscape. Tensions between the US and China have escalated once again. The Chinese Foreign Ministry has formally accused Washington of violating the terms of a recent tariff ceasefire, citing new restrictions on AI chip exports and visa limitations for STEM students. These developments are reigniting fears of a tech Cold War, with Bitcoin and other decentralized systems caught in the geopolitical crossfire. As capital looks for safe havens, Bitcoin appears to be benefiting from this uncertainty. The narrative of Bitcoin as digital gold has gained traction once more. In fact, Several analysts at major US banks have updated their long-term BTC price targets. JP Morgan recently raised its 2026 projection to $180,000, citing macro hedge fund demand and the growing appeal of non-sovereign stores of value. Meanwhile, the Federal Reserve is maintaining its cautious stance. Despite mounting pressure to ease monetary policy, the Fed has kept interest rates steady between 4.25% and 4.5%. In recent statements, Fed Governor Christopher Waller said that the central bank remains data-dependent and is not yet confident that inflation is sustainably on a downward path. The next CPI print, due later this month, will be critical. Interestingly, the Fed also revealed that it has posted a second consecutive year of negative net income, something it hasn't done in decades. This financial stress, largely due to its ballooning balance sheet and interest payments on reverse repos, raises questions about the future of central bank credibility. In parallel, Bitcoin's fixed supply and predictable issuance schedule stand in stark contrast, reinforcing its value proposition for those seeking monetary certainty. In terms of public perception, Bitcoin's mainstream image continues to evolve. A recent survey from Deloitte found that 62% of millennials in the US now consider Bitcoin a safe long-term investment, up from just 42% 2 years ago. The same report noted a surge in demand for self-custody solutions, with companies like Ledger and Trezor seeing record hardware wallet sales. Education and adoption are also on the rise. The University of Texas just launched a new blockchain engineering program, and MIT has expanded its digital currency initiative to include applied cryptography labs. These developments reflect a deeper integration of Bitcoin into academic, financial, and cultural institutions. On the global stage, the IMF has issued a new report cautioning against outright bans on Bitcoin. Instead, it recommends regulatory frameworks that recognize Bitcoin's utility in remittances, inflation hedging, and cross-border trade. The report acknowledges that attempts to suppress Bitcoin have largely failed and may even backfire by pushing innovation underground. Back in the US, regulatory clarity is improving. The SEC recently approved a framework that distinguishes between Layer 1 tokens like Bitcoin and Layer 2 application tokens, potentially paving the way for streamlined disclosures and less regulatory overlap. This could reduce compliance costs for exchanges and fintech firms while offering greater investor protection. As we wrap up, let's take stock of what this all means. Bitcoin's current price action above $105,000 is not just a technical phenomenon. It's the result of years of evolving infrastructure, changing investor psychology, and broader macroeconomic transformation. From ETFs and miners to sovereign reserves and student programs, Bitcoin is touching nearly every corner of modern life. Yes, there are risks, both in the market and in the geopolitical sphere. But what makes Bitcoin remarkable is its resilience. Each cycle has brought new challenges and new players, yet the protocol remains unchanged. The network continues to grow. The hash rate climbs. And the belief in a decentralized financial future becomes harder to ignore. So, what should you watch for next? Keep an eye on ETF flows, upcoming Fed decisions, geopolitical shifts in Asia, and the June CPI numbers. These events could serve as key catalysts, or turning points, for Bitcoin's next major move. For now, the king of crypto holds firm above 6 figures, and the world continues to take notice. Stay informed. Stay prepared. And as always, stay decentralized.